My name is Dan Dorval, and I'm President and CEO of Dorval and Cherney Financial Advisors. I am an independent certified financial planner and author of my book, Financial Success for the Rest of Us, Reality-Based Financial Planning for Mainstream America.
Hi, my name is Leah Woodley. I'm an associate financial advisor with Dorval and Cherney Financial Advisors. Our conversations discuss what it means to do quality of life planning in all areas of your life.
Dan, in your book, you talk about risk management, and I know that's a subject most people don't really like to talk about. I don't even know if we always like to talk about it, but it is something that is important to consider. How do you define risk management in a financial plan?
Yeah, it's as we talk all the time, it's different for everybody.
Mhm.
Different people have different types of risks. And typically, if you have a financial risk that you cannot accommodate on your own, so for example, a young family and one of the spouses dies, and maybe now you're not financially able to take care of that family, you are normally going to address those types of risks with some form of insurance. So,
Mhm.
insurance is your risk management approach to any risk that you are not financially able to absorb without impacting your quality of life in an adverse way. So, the very premise of initial risk management is to have a cash reserve for emergencies. That's how you
Mhm.
can control it. So now I have my cash reserves, my furnace breaks down or something happens. I use my cash, I pay for it. Now, what a lot of people do is they'll buy insurance for things like that. They might insure, they'll have like an extended warranty on their furnace, or
Mhm.
they'll buy insurance for various things that would not be financially catastrophic. And we know that insurance companies are in the business to make money. So if they're selling you insurance to insure maybe an appliance, they're making money off that. So that means you're losing money on that typically. It's not a money
Mhm.
making venture to buy insurance. It is a risk management tool. So if you're financially able to pay for that furnace on your own, you don't need to buy insurance on it, which saves you an enormous amount of money over an entire lifetime. Now, that being said, there are risks like dying, disability, healthcare, where you may not be able to financially absorb a heart surgery that costs hundreds of thousands of dollars. So now you buy insurance. And that insurance should be aligned with what the risk is that you're trying to insure.
So you mentioned one way people can protect themselves from being sold more insurance than they actually need. Are there any other ways that people can be cognizant of how they are purchasing insurance so they're not being sold more than what they actually need?
Well, it feels like in today's world, you could buy unlimited amounts of insurance, and everyone trying to sell it to you is going to position it as, well, this eliminates this particular risk. Well, that sounds good to us, right? I don't want to have, major risks. I don't want my car to break down and potentially have thousands of dollars in repairs. But at the same time, if I'm paying $100 a month for that insurance, and I'm only going to have that event occur, maybe every 5 or 10 years, if ever. Well, I'm just essentially on a prepayment plan where I'm paying a lot for something that I could have paid for periodically anyway. But if people don't save money, if people don't have an emergency reserve, they have to resort to these types of insurances because when I have that $5,000 or $10,000 event, I can't pay for it. In which case, I'm going to put it on a credit card or I'm going to borrow in some way. The insurance might be a more efficient way of dealing with it than putting it on a credit card.
Mhm.
So we start with that premise. But then when you get to insurance, like the big insurances of how much do I really need, that's when your personal circumstances come into play. So if we talk about life insurance, for example, we'll see life insurance salespeople, really abuse that process because it's a very emotional thing. We're talking about somebody dying. And so the idea of the salesperson is to get you into an emotional reaction, in which case they paint a picture. where you say, okay, if I died, that would be tragic. I feel bad. Boy, would it be nice to have money for my heirs. And then you get sold insurance. Well, if you don't have anyone that you're financially responsible for, so maybe you're a young single individual, you're just getting started in your career, no one else you're not responsible for anyone else's quality of life. Life insurance is not for you.
Hmm.
It's for your beneficiaries of the life insurance. You in this scenario, you've passed away. It's to protect someone else. And so for
Hmm.
somebody who's not responsible for someone else, it is very rare that you need life insurance. Now, that
Hmm.
could also be true that if you have been financially responsible over your entire life, and now let's say you're getting ready to retire, and maybe you're in a position where if one of you passes away, or if you pass away, your heirs are going to receive all of your assets, and it's not a financially catastrophic situation. Maybe you don't need life insurance there either. So you might
Hmm.
not need life insurance here, and you might not need life insurance here. But in the middle, I might be married, I might be raising children, I might have a mortgage, I haven't accumulated a lot of assets. If I die, my family could be very adversely affected. And so, if I understand when I need the coverage and for how long, now instead of buying maybe a very expensive policy that lasts my entire life, maybe I could use term life insurance instead and design it for the specific term of greatest need or the time of greatest need. And I might save an enormous amount on life insurance where those resources could then be applied to other financial goals.
Thank you for sharing that. That was so helpful. So, a big concern of a lot of people right now is health insurance. And you highlight the difference in what your health insurance cost 20 years ago to now. How has the cost of health insurance changed over the years, and what should families be prepared for now?
Well, healthcare has advanced in tremendous ways. And so we can fix almost anything now with very advanced surgeries and, all sorts of therapies for cancer and all of that. And it's become enormously expensive. So if you've had a situation with cancer, for example, and you had treatments over the course of years, those treatments might amount to potentially millions of dollars. Well, if it's millions of dollars, somebody has to absorb that, and it's being absorbed through the insurance industry. Well, uh, a long time ago, what happened is we could buy health insurance. It was expensive, but we could buy health insurance for, I would say, something considered reasonable. It might have been for my family a few $100s per month for us to insure four of us. And then when we had a healthcare issue, we were paying deductibles and copays, and we had an HSA, a health savings account, in order to be able to help make those payments. Well, over time, the cost started to go up. So back in 2009, 2010, President Obama floated the Affordable Care Act. So you'll hear it referred to as Obamacare. And when they did that, they imposed a lot of guarantees on the system. Like the system has to cover this and it has to cover this. And there were a lot of mandates. And when we looked at it, we're like, okay, hold on a second. Like, yes, health insurance costs have been rising. But if you mandate more care or more coverage inside the policies, you're naturally going to result in higher care too, or higher costs as well. So then one of the biggest things they did that was a really interesting incentive is they capped the profit percentage on health insurance.
Mm.
So they said an insurance company can only earn a certain percentage of profit. Well, if you limit my ability to have profit, the best way for me to grow my revenue is actually for costs to go up.
Mm.
Because if I get, let's say, 20% profit on, $100 billion as compared to if I can get that cost up to $200 billion, I still get my 20% profit. I've just doubled my profit. The
Mm.
margin didn't change. So insurance companies, which historically had an incentive to try to keep costs low, all of a sudden insurance companies had the perverse incentive to try to maximize costs. And so you started to see healthcare providers and health insurance companies come together. So you'd get these big mergers of these huge companies, and they started to control the costs from beginning to end. And the insurance companies could maximize their profits by actually increasing the cost. So our health insurance as a family, and we have always bought insurance, as a non-group. We don't get it through our employer. We're buying it as a family on the private market. Our health insurance costs have skyrocketed in the last, well, certainly the last 5 years, but really since the Affordable Care Act went into play.
Wow. That's a big change, and I'm glad that you provided some context to what is actually going on because I'm not sure that a lot of people are aware. So, when it comes to disability insurance, that is something that a lot of employers offer. How much income replacement do you typically recommend? And I know if you're going through a group plan, you might not have control over that, but how much income replacement is typically necessary?
Well, I will tell you that disability insurance is one of the hardest things for us to talk about.
Mhm,
Because the first thing is, it's not always that easy to know what a disability is.
mhm,
Different policies have different language. So if I'm a nurse, for example, which we work with a lot of nurses, and I have some back issues or other things, and I go, hey, it's just very difficult for me to, turn a patient or, do some of the physical aspects of my job, you may or may not qualify for disability coverage, as far as a benefit, despite the fact that you feel like you can't do your job, because it's hard for an insurance company to define what is a back injury, right?
mhm,
If you're talking about life insurance, it's much easier. Somebody's either alive or they are deceased. And if they are deceased, the policy pays off. And if they are alive, it does not pay off. And so it's hard for us to talk about disability coverage because we don't always know for sure if you're going to get the benefit that you're paying for in the way that you think you deserve. So that's the first thing. Second thing is if somebody has coverage through work, now it starts to come down to okay, if I am disabled and I cannot work in the capacity that I work, do I have other resources available?
mhm,
Do I have a working spouse? Does my spouse make more or less than me? So if now I'm disabled and maybe my income goes way down, can we live on my spouse's income? If you can, your spouse is a big part of your disability insurance.
mhm,
Now, what
mhm,
if I'm the primary wage earner? My spouse has maybe a much lower wage or maybe no wage at all. My wife stayed home for a lot of years during that when we were raising kids. And so now my income is essential to the quality of life of our family. If I am disabled and cannot perform my function, well, I need to replace a very substantial portion of my income. So when you talk about that portion, in many cases, and this gets confusing because it depends on how the benefits might be taxed, a lot of benefits might give you maybe two-thirds of your income.
mhm,
But if you're paying for that with after-tax dollars, that means the benefit might be tax-free.
mhm,
And so I might get two-thirds of my income, but net of taxes, maybe that's actually covering the bulk of my income. And in most cases, a disability policy is never going to cover 100% of your income
right.
because then the insurance company knows you have no vested interest in ever getting off disability. If I'm only covering a portion of your income, maybe 50% up to two-thirds, those would be common numbers. If I'm only covering a portion of your income, you have an incentive to go back to work so that you can make more income. So
Mhm,
in this case, when we talk about like a group policy, which many employers will offer some form of group, that group might be a very basic policy. It might not cover your own occupation. So that's another important issue. Like, if I'm a surgeon and I need my hands to perform, my function, and now my hands get harmed in a way that I can no longer perform surgery, if I don't have own occupation coverage, they'll say, well, yeah, your hands are affected, but you could still go work in another
mhm,
job that would just pay you
mhm,
dramatically less. So if you have a very specific type of work that pays you well, you typically want to get own occupation coverage. Well, your
mhm,
group coverage may or may not have that provision. So if your coverage through the group does not fit your situation very well, then you might supplement that coverage with an outside disability policy. We will see many doctors, for example, have an outside policy. In our case with nurses, their group coverage is pretty good for their situation. A lot of times we don't recommend having coverage outside of their group policy. So this is where it's different for everybody. And it is very challenging to deal with disability coverage because it can be very expensive. And yet at the same time, we don't even know if it's going to give you a benefit if you're disabled.
Hmm. Yeah, we've seen that sometimes where lawyers had to get in place because there was conflict over whether someone was actually disabled or not. So thank you for highlighting that. Last question I want to ask. You and Tracy had a very specific approach to determining how much life insurance you wanted to have. It was a very well thought out, you considered values and what was important to each of you. Why don't you describe that process that you all went through?
Well, when we talk about life insurance, a lot of times people just use rules of thumb. They might
Mhm.
say 10 times your salary or, some general rule of thumb. We didn't look at it that way. We just look at core expenses. Like if one of us passed away, what would you need for, to be able to deal with this? And the first thing that I usually start out with is pay off all of your debt. So if you
Mhm.
have a mortgage, if you still have student loans, if you have other things, dependent on if those loans would be forgiven upon death. But if you have debts where at your death, now your spouse might have trouble paying for those. At a minimum, it's nice to be able to have that death benefit just pay off those debts, and now you've reduced the expenses to the household. So that's one thing. Then you start looking at, okay, do we need money to help pay for school, like college? Well, we had specific college goals. And so you might set aside a certain amount of death benefit and say, okay, as one spouse, one surviving spouse, I may not be able to save for college anymore. Money's going to be tight. So if I can just set money aside for college, I've taken care of that goal. I just don't worry about it anymore. So you might have debt first, then you might have specific goals like college or other things, and now you have an amount for that. Then when you get into, okay, how much income do I now need? Those are based on the expenses and the quality of life of the family. It's not how much income you earn, it's what expenses do you need, kind of like retirement planning.
Mhm.
So then you look at that and you go, okay, what do I need to replace not my income, but what do I need to replace just the expenses associated with if I am gone, how does my family maintain quality of life? And you add those components up. And then what you want to do is you typically want to over insure with term life insurance. Term life insurance is very inexpensive for the most part. And so if you estimated you need, $1 million of term, you could easily buy 1.25 million or 1.5 million, have a modest increase in cost because it's only for a specific period of time. And now, if you pass away, you know your family's okay because none of this stuff is exact.
Right.
If you're buying permanent life insurance, so this might be whole life, universal life, index life, variable life, there's a lot of different kinds of permanent policies. Those are meant to last over an entire lifetime. And the insurance company knows that if you keep that policy in place over your whole lifetime, they're going to pay a death benefit someday.
Mhm.
That might be when you're 80 or 90 years old, but they're going to pay a death benefit someday. That means the cost is going to be much, much higher. With term life, the reason why the cost is so low is if I insure myself for 20 years or 30 years or whatever time period, the insurance company can calculate the risk and know that only a small percentage of people are going to die during that time period. So they're going to collect a smaller premium knowing they're probably not going to pay a death benefit. That
Mhm.
makes your insurance much more affordable and much more reasonable. So you align the insurance with when you actually need the coverage.
Well, thank you so much for sharing. I think one overarching theme throughout this discussion of risk management is that it is extremely personal and it's not, we can't go by a rule of thumb or just some general advice that is out there. It is unique to each family and each individual. Is there any last things you would like to highlight about risk management?
Yeah, I had disability coverage for a long time, but I didn't design it to be anywhere near my total income because we also had a provision through our business where if something had happened to me, whether I was disabled or I died, so this kind of relates to small business owners out there. We had something called a buy sell agreement that addressed those provisions where the company would actually pay a certain amount to my family in the case of death or disability, and so that was my form of insurance as well. So you see how specific those cases are. Well, now that I've gotten older, we're in a position where I would be able to retire if I were disabled. So I
Mhm.
dropped my disability coverage. You don't need coverage if you have the financial means to be able to deal with the risk that's out there. And so in my case, I saved that premium. Now, if I were disabled, yeah, it would be a problem for us as far as, I wouldn't have work income anymore, but we're financially able to absorb that. So you don't want to insure for every single risk that
Mhm.
exists. You want to insure for risks that would be financially catastrophic to you as a family.
That is such a crucial point. Thank you for sharing that. Well, until next time, have a great one.
Thanks, Leah.
You too.